very strongly. The other factor that can affect your investment is the economic growth or the output growth, which is called the accelerator model. So first, today's investment will depend on future growth, right? So the future growth means future demand. So today's investment will be determined by the future demand. But we do not have the data on the future demand or the future economic growth, so that's why the economists will use the current economic growth for which the data are available. Okay, so we proxy the future economic growth based on the current economic growth. So if the current economic growth is higher, we then say that the future economic growth also will be higher, and to finance or to meet the demand, future demand, the investment will be higher, and the higher investment also will feed into higher economic growth as well. So then the economy will accelerate at a faster rate. So that's why it is called the accelerator model. Okay? Which is that the investment is determined by the economic growth. The exchange rate, we know that in many developing countries the exchange rate is controlled. So that's why I use the term devaluation rather than depreciation, because it is control of the fixed exchange rate system or the managed exchange rate. Now, if you go for a devaluation of the exchange rate, of course the exporters are happy. So your export will be higher, and the investment in the export sector will take place. But at the same time, there will be a decline in the investment in the non-traded sector, because the non-traded sector, they may import some of the raw materials, they may not export those. So because of the devaluation, your import bill could be higher, your raw materials could be expensive, whereas if you do not export your finished goods, your output, then this sector will lose out when there is a devaluation. And also, the devaluation may increase the cost of production in the sense that your raw materials could be expensive. It could be oil price or anything if there is a devaluation. So the overall cost of production also can go up, and also the non-traded sector will not have any compensation because of this devaluation. Okay? So therefore, there will be a decline in the investment in the non-traded sector, and there will be an increase in the export in the traded sector. So we don't know whether the net effect will be positive or negative. It depends how globalized the economy is and to what extent the economy is producing for the domestic market and what proportion of their output is being exported and so on. So it will depend on the structure of the economy. So that's why I said that the net gain is a bit uncertain. It can vary from country to country in terms of the overall level of investment, whether it will be positive or negative. And then we have got the irreversibility. That the irreversibility means, in some cases, once you make the investment, you cannot take it out later on. Okay? It is not reversible in the sense that if something goes wrong down the road after 2 years, suppose the economic condition changes, you expected economic boom, but then you invested in 2006 or 2005, then in 2007 there was a recession. Okay? So in the developed economies, you can sell your investment, or you can sell your equipment and the plant and everything at some price. But in the developing countries, it is very difficult. Once you make the investment and if something goes wrong, when you are withdrawing your investment, no one will buy your capital basically. So that means that the investment will be irreversible. And if I know that the investment is irreversible, then I will delay my decision. I will wait for a while. Okay? So that if everyone waits for a while to see what is happening, if suppose there is a general election coming up next year, then everyone will wait. They will not invest this year. They will say that, okay, let's see which government comes into power next year, whether it is investment friendly or not, and so on. Okay? But if everyone waits for next year and the next election, then this year the overall investment will be quite low. Okay? And therefore, the year out, the growth rate also will be lower. So this irreversibility will cause a delayed investment, and then overall investment level will be lower. And there could be uncertainty in terms of inflation, in terms of the policy, in terms of the continuation of the policy, and other political instability. So all these uncertainty also can affect your investment negatively. Okay. And then lastly, the capital market. Okay. of which this financial system is part of the capital market. So we know that in the developing countries it is fragmented. Okay, it is narrow, it is fragmented in the least developed countries. Why fragmented? Because not everyone has got the equal access to this market. Okay? So the market, you cannot really move from one place to another place, or one bank to another bank, or from rural to the urban, or even within the formal sector. Maybe there could be segmentation between agriculture and industry. Some banks, they lend money to industrial sector. Some banks, they lend money to the trade sector. Some banks, they lend money to the agricultural sector. So they have got their own priorities in mind, and therefore overall the capital market is quite fragmented, and it is also narrow in the sense that it is not just the commercial banks, it is also the other banks as well. You can have, other than commercial banks, there are banks called the development banks, okay, which are like specialized banks like the industrial development bank. So they will finance only the industrial capital, for example. You can have agricultural development bank. You can have the rural development bank. Yeah, so like this. So you can have these specialist banks, and also you can have the stock market as well. But the overall market capitalization is very low in the sense that you really cannot raise enough money from these capital markets. Okay? Because if you go to the capital market, then they will say, okay, how much money you can borrow from the banks. If you go to the bank, they will say how much money you can raise from the stock market. If you can say that, well, these banks are ready to finance my project, but still I need another 20% or 30% equity, then possibly the capital market will be able to raise money from the capital market. So there is a complementarity between the banking sector and the capital market. If you fail to raise money from one sector, then it is very likely that the other sector also will not lend you money. Okay? So therefore, many big projects cannot be undertaken when you have got this type of shallow capital market, or where you do not have enough credibility to raise money from those two sectors. Okay? So that will ultimately affect the overall investment. Okay? So in that sense, the financial sector can have a significant role in addressing or to address this narrowness and the fragmentation in the capital market. Okay. So now we know that what are the determinants of the investment, and let's see to what extent the financial sector can affect, financial system can affect this investment or the capital formation. Now, these are the two features. The first feature is that we know that in the developing countries there is informal financial sector, which are normally rural based. Okay? So the people borrow money from village money lenders, they borrow money from their relatives, they borrow money from their let's say the small scale lenders within the village and so on. Okay, so they could be very much informal, they could be semi-formal, because you are quite aware of this microfinance institution, microcredit, which I discussed before. So there are various types of institutions that are operating in the financial sector. So these informal financial sector, they are not part of the central bank's supervision or the guidance of the regulation. Okay? So they are above, or they're beyond this central bank's supervision, because by nature they're informal. Now the problem here is that if you have got a very large informal sector, but then even if you have got a very much independent central bank, let's say, for example, the Monetary Policy Committee or something like that, then what happens, even the strong central bank or independent central bank cannot affect the economy to a great extent, because the informal sector is outside your control. Okay, so therefore, even if you increase the money supply, maybe in the informal sector, there will not be any repercussion. Maybe in the informal sector, the interest rate may not go down. Normally, you say that, well, if there is economic recession, the central bank can reduce the interest rate, fine. But that reduction in the interest rate can only affect the discount rate, and that discount rate can affect the formal banks. I hope you understand the discount rate, which is the rate at which the commercial banks can borrow from the central bank, right? So when the central bank lowers its interest rate, which means that these commercial banks can borrow money from the central bank at a lower interest rate, and therefore they can go for further lending at a low interest rate. So therefore the economic activity, the investment, everything goes up. So that's the normal operation of the central bank through the discount rate. But in this case, if you have got the informal financial sector, that will not happen, right? Because these informal lenders, they don't borrow money. They can't, in fact, they can't borrow money from the central bank. So therefore, any central bank operation, whether it is open market operation or monetary policy or any other policy, cannot affect the vast majority of the population who are engaged in the informal sector. Okay. Okay. Then what about the formal sector? In the formal sector, we know that the many developing countries, the formal financial sector is repressed. Now, how do we define repression? There is no unique definition of repression. We can only say the extent of repression. It is highly repressed, partially liberalized, but we can't say this is completely liberalized, this is highly repressed, or this is liberalized, or this is repressed. There could be many arrangement in between the liberalized and repression, liberalization and repression. Okay? So there could be a degree. So we can just assess the degree of liberalization or degree of repression. Okay? You can score them with 3, 4, 5 or whatever. You can have some index number on repression and so on. So that's why I have outlined or I have included some of the features of repression, but this is not an exhaustive list of repression. You can add some other elements as well. But these are the main ones. That in a repressed financial system, we observe that there is a clear distortion of the financial prices. By financial prices, let's say it is the interest rate. Okay? So the interest rate is highly controlled. How is it controlled? It is through an administered ceiling on the interest rate. Okay? So normally, the state or the government or the central bank, they set the interest rate which the commercial banks will have to follow. Okay? So the banks are not free. The commercial banks are not free to set their own interest rate. Okay? So there, and normally they put a ceiling, the highest amount they can charge on this highest nominal interest rate they can charge. So in that sense, if you control the price, if you put a maximum price on something, there will be excess demand, right? For any commodity, if you put a ceiling on a price, if that ceiling is lower than the market clearing rate, okay, or the price, if the administered price is lower than the equilibrium price, then there will be excess demand. And because of the excess demand, there will be credit rationing. Okay? Because it is cheaper, because it is controlled, it is cheaper. Many people will be willing to borrow money, but they cannot borrow money. Okay? So that is what we call this the administered ceiling on the nominal interest rate can lead to a credit rationing in the under a repressed system. And also we observe that in a repressed system, the government controls a significant amount of resources, the banking resources, financial sector resources. It could be in terms of the deposit, it could be in terms of the lending, or it could be in terms of the number of banks owned by the government. So it's not always in terms of the number of banks, right? Because in many countries, you will find that the state or the government may own just 2 or 3 banks. But you can have like 30 other private banks. That doesn't imply that the financial system is not repressed. The repression should be just in terms of the control over the resources, the control over the deposit, and the control over the lending. Because in many countries, these 2 or 3 banks, they operate all over the country. And that's why they can mobilize huge amount of savings from the rural areas. Then you can have 30 private banks, but they operate only in the big cities. You can have even the foreign banks. You hardly find any foreign banks operating in rural areas. They only operate in the big cities. So therefore, it is not in terms of the number of banks, it is also in terms of their coverage, in terms of the resource mobilization, savings mobilization, in terms of their investment lending and so on. That's why we say that we need to look at the overall asset, okay? In the total banking sector's asset, how much is controlled by the state banks, okay? So, or in terms of the deposit, in terms of the lending and so on, okay? So that's what we call the government monopoly, but it might not be monopoly, it could be oligopoly, in fact, okay? So there could be a huge amount of government control over the banking system, and also sometimes the government creates the barriers. Okay?